If you've spent any time at all looking at trading charts or scrolling through trading forums, you've definitely hit this massive wall. It's easily one of the most hotly debated topics in the retail trading space today. So in this explainer, we're diving right into the great divide of our time, order flow versus ICT, and looking at how bridging this massive gap might actually be the key to dramatically improving your trading.
This exact question is quite literally tearing trading communities apart, isn't it? It forces beginners into feeling like they're standing at a crossroads where they absolutely must pick a side. You hear it all the time. Should I switch to Orderflow, stick with ICT, try to combine them? But hey, before we can even answer how to trade, we really need to look at what's actually driving this incredible divide in the first place.
Well, when you dig into the source material, a super crucial fact emerges right out of the gate. This strict us versus them mentality, it's largely a marketing illusion, engineered specifically to divide the audience. The intense tribalism you see online isn't necessarily born out of actual trading mechanics. It's a carefully constructed narrative designed to make you feel like one side is 100% right and the other is totally wrong. Just look at how a lot of trading mentors operate. They literally create rumors that the other trading style is obsolete just so they can sell you their specific course. An order flow mentor is going to tell you that price action is dead, and conversely, a price action mentor will swear that order flow is a scam and indicators are useless. They create these biases just to divide the masses for profit. But right now, we're stripping away the hype and looking at both sides objectively.
To cut through all that marketing noise, let's break down the first camp, price action, which is often branded today as ICT. What actually is this methodology at its core once you strip away all the flashy social media branding?
Basically, price action is an approach where you rely entirely on the visual reading of a completely naked chart. You're looking strictly at how the price moves, analyzing the wicks and the bodies of those candlesticks. Now, the source notes you can absolutely be profitable this way. In fact, they mention making money early on using just raw price data. But the big takeaway here is that price action is entirely visual. Zero additional background data indicators. You're predicting market direction based solely on the shapes and patterns the candles leave behind.
In practice, traders use this visual method to spot things like fair value gaps, order blocks, or liquidity sweeps. They'll look at a gap left by a rapid price movement and decide subjectively that it's a target for price to return to. But pay attention to that word, subjectively. You're looking at a raw chart and essentially guessing, based on your own visual interpretation, where the market might reverse.
Okay, let's switch gears. We need to look at the alternative that so many price action purists actively ignore or even attack, order flow. Think of it this way. If price action is about looking at the shiny surface of the market, order flow is about lifting the hood and looking directly at the massive, data-driven engine underneath it.
The core difference between these two warring factions really comes down to art versus science. While price action is a subjective visual art, relying on how you personally interpret a chart pattern, order flow is an objective science. It's based entirely on unchangeable background volume data. With price action, your margin for human error is pretty high because you have to personally decide if a zone is important. But with order flow, the data simply tells you, plain as day, if the zone actually has activity or not.
By utilizing tools like the volume profile, VWAP, or footprint charts, you simply don't have to guess anymore. You can see exactly where the heavy buying and selling is taking place right inside the candles. A volume profile shows you the precise number of orders executed at a specific price level. So instead of just hoping a zone holds up, you're actually looking inside the candlestick and seeing the real money changing hands. It's a total game changer.
Which brings us to a very logical question. If order flow gives us all this incredible, objective data that takes the guesswork out of the equation, why on earth do some traders aggressively avoid these tools? Why the massive pushback against using anything other than a naked chart?
While the source traces this bias all the way back to a specific era of online scammers. Years ago, there were countless fraudsters selling these useless, flashy buy and sell indicators to beginners. It essentially created trading PTSD for an entire generation. If someone saw an indicator on your screen, they instantly assumed you were a total novice being scammed by a fake tool. That historical baggage is the exact reason so many modern traders proudly brag that they trade without indicators.
But here is a major paradigm shift from the source material, and it's honestly a brilliant way to reframe your thinking. A naked candlestick is not pure magic. It is simply a visual indicator showing you past and present price levels. Literally everything on your screen is an indicator. The candlestick indicates where the price opened, high, low, and closed. Once you accept that reality, the whole prejudice against using volume tools completely falls apart.
So, the crucial takeaway is this. If everything on your screen is technically an indicator, you shouldn't be stubbornly choosing between them. Don't let marketing tactics force you into a camp. Instead, you should be combining them to build a robust, full-picture strategy that gives you the ultimate edge. The ultimate synthesis connects the where with the if. You use subjective price action to find a setup zone. That gives you your where. Then, you use objective order flow tools to verify if the real volume actually agrees with you. That gives you your if. You find the zone visually, and then you confirm it with hard data. It really is the best of both worlds.
Because let's be real for a second. If you only look at a raw chart, you're going to see a dozen fair value gaps and order blocks. They are literally everywhere. Try to trade all of them, and you will get chopped to pieces. Bringing order flow into the mix helps you filter out all that noise. When you check the volume profile, you might see that a beautiful-looking fair value gap actually has absolutely zero supporting volume behind it. Order flow stops you from entering those empty setups and highlights only the highest probability zones.
This builds into a highly effective three-step process that can literally cut your decision-making error margin in half. Step 1. Identify your visual zones. Step 2. Apply the objective filter using unchangeable volume data. And Step 3. Drastically reduce human error so you can make high-probability decisions.
What's genuinely fascinating about this synthesized approach isn't just the technical advantage, it's the mental one. Replacing subjective guesswork with objective data gives you immense psychological comfort. When you take a trade because the hard volume data actually backs it up, your brain is just more relaxed. You aren't sitting there nervously wondering if you drew your little box correctly. You're trusting undeniable market mechanics.
As we wrap up this explainer, I want to leave you with this one thought. Will you let online marketing and tribalism dictate your strategy, or will you build an objective, volume-backed edge? Don't let someone trying to sell you a course dictate what tools you're allowed to use. Combine the visual clarity of price action with the undeniable truth of order flow. Verify your volume, filter your setups, and trade with unshakable data. So what's your next move going to be?